topic. We have someone here who wrote a wonderful book which is called Das ehrliche Geld. He already pitched it a little bit in the beginning of the day. Maybe we also hear Pius again afterwards on stage. You will share this panel a little bit. Feel completely free. We're a team here. So please make a big round of applause for Alexander von Frankenberg.
I studied in Austin, Texas in 1990, and they all had Apple Macintosh computers. I became a big fan of Apple Macintosh because they were more user-friendly, they had more functions, they were nicer, they were very hip. And I invested almost all of the very little money I had in Apple stocks. And in 1995, Apple was about to go bankrupt. It was saved by an investment from Microsoft. And I really was amazed that the better product, the better technology would lose. So I wrote a PhD thesis about that very question. What make one technology become a de facto standard? And that relates a lot to network effects. If there's strong, unlimited network effects, then the technology becomes more and more useful with adoption. And that's why we have no chance against the American platforms, because they're so strong network effects. No chance, no regulation, nothing can save us from going to the most useful technologies. And it's very difficult to kick them out. So Apple didn't go bankrupt because of the investment, and I sold all my Apple stock in the bubble 2000, and that cost me 2 million euros if I had kept the Apple stock. So the lesson really is the value is being created in the long term, and it's a very bumpy ride. I became a venture capitalist 25 years ago, 20 years with High Tech Gründer Fund, very successful fund. We did 800 investments. About half of them failed or will fail, and you don't know which ones. It's impossible to predict, obviously, because if you could predict it, then you wouldn't make the investment. And even with the successes, one of the companies I directly took care of was just sold for 2 billion euros to the US, $2 billion to the US. And I made the investment in 2011, and they do connected fitness equipment. eGym is the name of the company, out of Munich. And the company was about to go bankrupt during the Corona crisis because all of their customers, the fitness studios, were closed down. So when did it become clear that they were successful? In 2023. So, and now they were sold early this year to the US. So even with the big successes, 2 billion is the biggest success we did out of the 800 so far. We don't know it. It's very hard to predict. So I jump over to Bitcoin. First of all, I think Bitcoin is already the de facto standard for store value in the crypto world. And there's a talk on YouTube where I talk about the network effects that Bitcoin has, and I make the point that if Bitcoin becomes the de facto standard for store value outside of the Bitcoin world, it's going to go to 10 million per coin. So recently we heard again Bitcoin is dead because of the price action. So I have 5 parts. Big picture, the big picture. And then the cycle, competition, a little bit about quantum, not much new because most of the things were said, and then a projection, summary. So the big picture, and that point I think is really important, it didn't change. And I have huge trust in the fact that you cannot trust the governments, and at all, with regard to money, and with other things also. Here you see the inflation data since 1971, when the dollar was depegged from gold, all over the world. And the lowest, congratulations, Switzerland, 2.2%. Not one country in the world has an average inflation rate below 2%, which is the goal of the reserve banks. And then you see the 5% line. Most of the countries are above that, and it's 10% and higher. And in the very long run, 71, that's of course 55 years, even small inflation has a huge impact on your purchasing power. So 3% inflation, 80% is gone since 71. And then 5% inflation, and most of the countries have more than 5%, 94% is gone. And that picture doesn't change at all. And you see it on the next slides. The debt levels, here you have Germany, the solid Germany, we used to be solid. It's exploding, and it's exploding because of the money we're spending on defense and of everything else. And you can argue that that makes sense, and the level is too low in Germany, that level, so we should increase it. What you cannot trust government with, the Chancellor Merz, before he was elected, 4 weeks before he was elected, he said, we're going to stick to the debt brake, we have enough debt. And then quickly after he was elected, he changed it. So he blatantly lied, and there's so many lies flying around all over the place that they do whatever they want, and obviously print money by increasing debt. And of course, the Americans, they have a very unsustainable debt level. Switzerland, I think, is one of the very few exemptions in the world. So next to the explicit debt, there's implicit debt. And here you see unfunded pension obligations. And that's the green. The green is unfunded. And then you see funded. And that's in relation to the GDP. And the solid Germany here is like at 350%. So even the solid Germany is not solid at all. And then there's like the civil servants' unfunded levels and unfunded infrastructure investments, replacement investments, so much debt rolling into the system, especially with connections to defense, demographics, infrastructure, education, that it's very, very, very obvious that there's going to be much more debt, and debt creates money, and money creates inflation. So having a solid store of value is ever important, is very important, as it always has. That picture didn't change, and it will not change in the future. So the big picture, store value, you need a store value because huge inflation happening and rolling in won't change. So, but then Bitcoin behaved, Bitcoin store value, limited, transparent, behaved a little funny recently. So we have to look at the 4-year cycle that Bitcoin has. And what we know, what we think when we look at average returns, we think of that picture, like the German stock market returned 8% since it was set up in like the index, the DAX, in '87. But then, of course, that's the reality. It's not a straight line with any asset. But with Bitcoin, it's more volatile than with. I have a chart in a second. So let's look at the 4-year cycle. The black line is the price on the right-hand scale, and the red graphics is the drawdown from the all-time high. So if here and here we are at the all-time high, and then it goes down. And so far we've seen roughly 4 cycles with drawdowns, 92%, 82, 77, and so far in this cycle, only 52%. And what we also see, the last 3 cycles were exactly 4 years. So maybe that's it's not a huge statistical sample, but 4 years. The first one was shorter, actually. And then this cycle just started, and actually it did start right on time, exactly 4 years. It was October 10. Also, the all-time high was October 4, and then. So what we see also within this 4-year cycle, from the all-time high, it goes down and goes back up to the original all-time high within 3 years. So in the last cycle, it was 2.5 years. So it was a bit quicker. The cycle changed a little bit. But that the 3-year cycle, all-time high going down, going back to the all-time high, 3 years, and then to the next new all-time high, another year. So the last cycle changed a little bit. So what's good about this? It's a buying opportunity. So I have two, and that's also in the book. I have two versions. You buy at 100,000. It goes down to 40,000 by 60%, goes back up to 100,000. You buy 1 Bitcoin, and then again, you have 1 Bitcoin. Obviously, you buy a Bitcoin, and then you have a big unrealized, hopefully, loss of 40,000. So on the other hand, you do dollar cost averaging. You start buying at the all-time high, and you spread all the purchases across the whole cycle. And then the graph shows you have a profit of 50,000. You have 1.5 Bitcoin. So buying through a cycle dollar cost averaging, when the cycle goes back up to the all-time high, increases significantly the return of the investment. So it is a buying opportunity. And the deeper the drawdown, the higher the return when doing dollar cost averaging. I think it's important to keep it in mind. So the cycle changed a little bit, the recent cycle, because usually it's a 4-year cycle. In the year 3, it's very green, and it was not green. Last year it was red, minus 6%. And so it rhymes, but it doesn't repeat exactly. So maybe the cycle changes, maybe not. Maybe it's an altogether different cycle. So what can we summarize about the cycles? Big drawdowns. So if the cycle continues, this cycle continues as the previous cycles, we're not done yet. 52% is not enough. But then it quickly bounces back within 3 years. That's quick. And then maybe a new all-time high 4 year. So maybe the cycle changed. There was no bull run last year. Actually, usually in the year 3 of the cycle, Bitcoin is the best asset class all over the place. But it was the worst last year. And this year, again, the worst. So if the cycle continues as last cycles, we're going to see a very choppy and drawdown until this fall. Competition. And I think it's really, really important to look at competition. If you look at the returns of several assets in the last 4 years, number 1 is NVIDIA. Number 2 is gold, 28%. And I claim gold is a significant competitor to Bitcoin, although it's different. Google. And then Bitcoin, not so bad, but not so strong, 15% in the last 4 years. And then S&P 500, 13%. And if we look at the absolute changes of the whole asset classes in the 4 years, and NVIDIA was adding 4 billion, German billion, trillion, American trillion. Gold was adding 20 trillion, a lot, as much as the whole S&P 500. Even Google added 2.5 trillion, and Bitcoin added 500 billion. So in absolute terms, Bitcoin moved very little, especially compared to its competitor gold. So what happened? Huge crises, Ukraine and everything. And central banks significantly bought gold. And then also the ETFs bought gold. So the reflex, and I show a graph in a minute, the reflex in terms of crisis is to buy gold. And we all know it's hard to verify, it's hard to transport, it's hard to divide. So Bitcoin is better in terms of, and we don't know how much gold there is and everything. But still, it seems like in the last 4 years, gold won the race significantly. And I think that's a good point, because if you look at the big platforms, if you look at Facebook and Google, in their early days, they were also competitors. And then there were phases when their competitors outperformed the later winners. In Germany, StudiVZ had a higher growth rate than Facebook, and that's the reason why Facebook wanted to buy StudiVZ for 10% of the Facebook shares. The owners declined, actually, and then wanted to buy it for 5% and 1%, and they always declined, so in the end, it went bankrupt. But there were times where StudiVZ was outperforming Facebook. And of course, you maybe remember there were many search engines, and there's many microchip processors and all of that. So competition plays a role for a while. And comparing the asset classes, looking at volatility, it's really interesting. With Bitcoin, next day volatility, Bitcoin going down is 47%. With stocks, 46%. 1 month, Bitcoin is 42%. Stocks a little bit lower, 38%. We jump to 1 year, stocks go down with a probability of 25% in the next year. Bitcoin, almost 25%, 23%. And then it changes. Now, stocks go down 5 years, 10 years, 10 and 6%, and Bitcoin so far didn't go down, almost. 5 year, like 0.2%, very, very little. And 10 year, 0. Well, there's not so many 10-year periods in the Bitcoin life. So, the competition. And then I looked at how long it takes for certain asset classes to go back to a recent all-time high. And I picked a few examples. Japanese stocks, all-time high, 89. It took 35 years. Gold in 79, Russia invaded Afghanistan, 79. It took 28 years for gold to go back to nominal value, not real value. Nasdaq 2000, 16 years. Stocks, S&P 500 and German stocks 2000, 13 years. Gold had an all-time high 2011. It took 11 years for gold to go back to that all-time high. And that figure actually is a little bit incorrect. It's not 3 years, it's 4.5 years with Bitcoin. So it's an error, actually, 4.5 years. So again, comparing gold and Bitcoin, 2 days ago, when the Iran war started, the only thing that traded was crypto, Bitcoin, and tokenized gold. And we can see in the reaction, Saturday, 10 o'clock in the morning, gold significantly jumps up, and Bitcoin significantly goes down. And that was just reversed today. Bitcoin just jumped up, and gold corrected back. So what we can state, although they're very similar as a store of value, they behave differently. So that's why I do think combining gold and Bitcoin in a portfolio does make sense, a lot of sense. Especially in these times. So, Bitcoin is almost back to 70,000 now, 69 something. And gold is 5,200. So they behave differently. So they are competitors in a way. So I think we should acknowledge that. And there's no Peter Schiff is right and whatever. Very little about quantum computing. We talked a lot about that. I think the main risk is to derive the private key from the public key. We talked about that. To manipulate unconfirmed transactions in the mempool. 51% attack, taking over the Bitcoin network and rearranging that, and disrupting the SHA-256 encryption. But as we heard today, it will take a while until quantum computing will be as powerful. And then I jump a little bit here. And I think we said that today, don't reuse the public key. You have to use it when making a transaction, so then it's exposed, yes. But there's a Bitcoin improvement proposal 360 that would make the public keys at all not visible. So that would be a very good protection from deriving the private key from the public key. Update of the address format that has been done, not very frequently, SegWit and Taproot. Of course, that has to be done before a secret quantum computer emerges and then just takes over. And then, of course, including quantum safe encryption into the Bitcoin source code. And I'm not an expert at all in the Bitcoin technology and the quantum technology, but I'm very confident that, and that Pius mentioned that the block size wars were very, very good story about how resilient the whole Bitcoin community is for changes that don't make sense. So it's about the block size, and I'm quite confident that the Bitcoin community, it's not just the developers, it's also the miners and the ones the users who use the nodes, who run the nodes, will come to a good solution in that significant time that's there. So what's my projection? And that's a very good strategy, a statistic that I found on Twitter. Here's the tweet. And whenever Bitcoin fell 40 or 50%, the worst year where that happened, with 40%, it fell to 67%. So another 27%. And 50%, it fell to 59%. So there's not much room to fall, looking at these statistics from the past, which they can change, of course. And then the median year when Bitcoin fell 40% was like plus 90 and plus 95 when Bitcoin fell. So it could be a very positive year. And that has happened before. The average year was higher than the median, and then the best year was significantly higher. And in the last column, I think it's important, the sample is not huge, but it's not low. So with 50%, Bitcoin falling 50%, that happened 98 times. So quite a bit. And 40%, that happened 137 times. And the win rate, you invest once Bitcoin falls 50%, which has happened, the win rate is almost 90%. So really, it's a good time to buy. I do think. I really think, even if it goes further down, as the cycle would suggest, well then, dollar cost average. Don't spend all your money at one point. And that's, of course, a statistic from the past. The future is unknown. We don't know what's going to happen. Things change, of course. So the worst year when Bitcoin fell 70% was positive. So in case it goes down 70%, just buy. Has been a good strategy in the past. So what's the summary? And I think the first point is really important. The big picture, why Bitcoin came into existence, connected to the financial crisis, because of tremendous money printing and the instability of the financial system, it didn't change at all. Elon Musk, the richest man in the world, about to cross $1 trillion, flying to Mars or Moon or whatever he does, he was not successful cutting costs in the American budget. If he cannot do it, no one can. No one. There will be no cost cutting in the big, in the US, in Europe. The only ones who maybe can do it are the Swiss. The big picture is unchanged. There is inflation. Inflation significantly devalues the purchasing power of the fiat systems, even the Swiss franc, in the long run. And there's a need for store of value. Bitcoin is not the only one. There's other ones. Big picture didn't change, and it will not change at all. Well, Bitcoin falls quickly. We've seen that. It hurts. October 10, now we have it's not even 5 months later. 4 months later, it was down by 50%. That hurts. That's quick. But the advantage of a quick fall is a quick rise. And we've seen the cycles, how long it takes to go back to the all-time high. Bitcoin is much quicker than any other asset. So, well, there's always drawdowns. Even the stocks, you have to stand them financially, of course, so don't leverage too much or at all. And you have to stand them emotionally. And that's tough, 50% or 70%. And then dollar cost averaging is a turbo for the return. And competition. And I think that's what we have overlooked, the whole Bitcoin community, that there is significant competition. And the interest jumped over to not stocks, but AI stocks, AI-driven stocks who made almost all of the returns in the S&P 500 last year, and gold. And that point is really important. Once that changes, once the gold buying of the central banks maybe stops, or they realize they have too much gold, maybe they need something else. And the purchasing power swaps over to Bitcoin. Bitcoin could very significantly outperform all the other assets. So we've seen 15% return with an increase of $500 billion in the market cap of Bitcoin. You can easily imagine what the returns will be if there's significant money flowing towards Bitcoin. Well, risks, opportunities. It's always opportunities. AI is an opportunity, quantum maybe is an opportunity, cheap energy is an opportunity. So I think, on average, we've seen more opportunities than risks in our lifetime. That's it. I still have six versions of the German book. There's a German audiobook on the market. And then in Las Vegas, end of April, there will be the English book and an English audiobook and a Spanish audiobook. So really, because the book, and what I'm doing with all the profits, I'm recycling it into the Bitcoin community. It doesn't pay too much, really. So if you buy the book, it's good for the community. So yeah, and it's really very good for beginners. So you're not beginners, but if you want to, my father-in-law, he's 88. And he hates gold and he hates Bitcoin. He read the book and he bought one Bitcoin. So it does. And then I asked him why he changed his mind, and he said, I have not changed my mind. I was always convinced that Bitcoin. He's a great guy. So yeah, that's it. And I think Piers has also some very interesting, he also was already on stage, and maybe some interesting comments on what I just said. The 4-year cycle might be an accident. It might be accidentally 4 years. So I think, I was convinced it would change. It didn't. So we'll see. Thank you very much. Hey.